This is how you should use the butterfly. Not like this. Not like this. And definitely not like this. A lot of traders use the butterfly all wrong. They treat it like a volatility strategy, except it really isn't. A butterfly is a cheap, defined risk way to make a directional bet. And when you place it at the money, like most people do, you flip the odds against yourself. Today, we'll show you why the out-of-the-money butterfly is the only way you should think of this strategy for a well-balanced portfolio. And later in the video, we'll tell you about the advanced version, the one we actually prefer as expert options traders to delete a chunk of your risk. By the end of this video, you'll place butterflies where they actually make money, not where most traders hope they will. Most traders place butterflies at the money, hoping the stock will stay pinned to one exact price at expiration. But that almost never happens. Here's real market behavior. If we highlight the periods where price actually moves sideways, like these yellow boxes, you'll see there are very few of them. What happens the rest of the time? The market is trending or cycling. Sideways price action is the exception, not the rule. So, building an at-the-money butterfly is basically betting that the market will pause in one of these rare moments. But even if you time it nicely, the real payoff, which is the blue curve, is way lower and flatter than the idealized black triangle. Because time decay eats away at the position long before expiration. So not only is the opportunity rare, the risk-reward ratio is also poor. All right, so if the stock won't sit still, how do we make the butterfly actually work for us? Simple. You shift the butterfly out of the money, above the market for a bullish trade, and below the market for a bearish one. Notice you have the same structure, the same wings, and the same triangular shape, but now it becomes a defined risk directional setup, not a let's hope the stock freezes setup. Think of it like moving the target to where the stock is actually going, instead of begging it to stay where it is. When you place butterflies with the trend, not against time decay, the whole strategy changes, and it suddenly makes more sense. And in a minute, we'll take this even further with the broken wing butterfly, the version that lets you adjust risk, or sometimes even delete a part of it. But first, let's talk about the 3 types of butterflies, and why traders get stuck in the wrong one. Before we go deeper into directional setups, let's step back for a moment. There are actually 3 kinds of butterflies, not just one. They all share the same basic payoff shape, a body strike, 2 wings, but they differ in how they're built and in where traders usually place them. First, let's see the iron butterfly. This one behaves a lot like the call and put versions, but it's built from a bull put spread and a bear call spread, so it's a net credit trade. It's the most liquid butterfly, which is why traders typically place it at the money. But as we saw earlier, those flat periods are rare. Liquidity doesn't equal effectiveness. Next, let's see the long put butterfly. This is the mix of a bull put spread and a bear put spread. Same triangular shape, same defined risk, but here's the interesting part. You don't have to keep it at the money. You can slide the whole thing below the price to create a cheap directional bearish setup. And when volatility decreases, that profitable area widens. Finally, a long call butterfly is the same idea flipped upward, a bull call spread combined with a bear call spread. And just like the put version, you can push it above the price to create a defined risk bullish setup. Same triangle, same cost efficiency, but now placed where the trend is actually headed. As you can see, the butterflies all share the same triangular payoff silhouette. But when you place them on real market behavior, their roles separate quickly. At-the-money butterflies only make sense when price goes flat, and that barely happens. But out-of-the-money call and put butterflies match the actual rhythm of the market, uptrends and downtrends. And this is the real takeaway. At the money, iron butterflies are liquid, but they only work well in rare opportunities. Out of the money, call and put butterflies, on the other hand, are directional tools. They're meant to follow the price, not wait for it to freeze. To strengthen why out of the money butterflies are better, let's forget the perfect triangle for a second. Because real trading doesn't look like this. It actually looks like this. In real life, your profit doesn't appear all at once at expiration. It grows slowly, day by day, if price stays near your target zone. And that's why out-of-the-money butterflies work so well. As price moves toward your zone, the real payoff curve, the blue curve, starts rising early, more or less as you would see with a simple long call strategy, at least at the beginning. You don't need the price to land at your perfect middle strike. This is because you are not aiming for a pin, but for a profit zone, a region where the blue curve is high enough to lock in a strong profit. And because the butterfly is cheap and defined risk, you might risk $40 or $50 to make $150 or $200 when the curve fills out. When your blue curve gets high, when price enters the heart of the zone, that's your exit. Most traders close when the butterfly doubles, or simply when you approach your middle strike. The truth is, there's no scientific rule here. Just don't wait for expiration. Close into strength when you have already achieved a very nice return compared to what you actually risked. And if price blows past your short strikes, the blue curve starts falling. That's where assignment and risk alignment come back into play. Another good time to exit. Remember, butterflies aren't traded for the expiration shape. They're traded to be closed before your options expire. So keep the blue curve in your mind when you use this strategy. After all, this is what makes out-of-the-money butterflies so effective. And by the way, if this helped you finally understand how to actually trade and close a butterfly, hit like and subscribe so you don't miss the next videos. But what if we told you there's an even smarter way to trade these butterflies than simply placing them out of the money? This is the broken wing butterfly. It's our absolute favorite, and it's a version of the butterfly that lets you reduce, shift, or sometimes even remove risk on one side of the trade. And after we cover this, we'll show you exactly where to find these trades inside Option Samurai, so you can spot them instantly. You break the wing by widening one side of the spread. That stretched side becomes flatter, meaning you have less risk if the trade goes wrong in that direction. And when you look at the real payoff curve, the one you actually experience, you see something even better. The declining side is gentler. You're now trading a butterfly with a friendlier downside, and sometimes there is no downside at all, meaning you will still profit if the stock moves far beyond your strike prices. So now you get the same target zone, the same directional payoff, but you're controlling risk in a way the standard butterfly can't. And depending on how wide you set it, the broken wing can even create a side of the trade that's entirely riskless. Traders often break the wing in two ways. If you're bearish, you make sure there's no downside risk. If you're bullish, you aim to eliminate the upside risk. This takes your directional butterfly and upgrades it into a smarter, more customizable version of the same idea. All right, let's jump inside Option Samurai and show you where these broken wing opportunities actually live. First, go to Predefined Scans and click on the butterfly tag. This opens all the butterfly-based setups we've already built for you. Now click on Riskless Up Call Butterflies. These are bullish call butterflies that gain value as the stock goes up. Cheap directional bets with serious profit potential. The scan looks for call butterflies with profit on the upside, a break-even point standing at less than 3% from the current asset price, and a strong profit ratio score. Basically, low risk, high payout potential. You'll notice we sort the results by decreasing profit ratio. And yes, it's not unusual to see theoretical profit ratios above 1,000%. Just remember the golden rule from earlier. You're trading the orange curve, not the perfect triangle. This is because you'll almost always close early, maybe at 200% instead of 1,000%. And honestly, that's still fantastic. If you like this strategy, you can also use the mirrored version for bearish markets. Or feel free to customize it. Add filters, tighten the criteria, change the expirations, whatever fits your style. Just remember to duplicate the predefined scan first, save your version, and make it your own. So that's the real way to trade butterflies. Not the textbook triangle, but the blue curve you actually experience in real trading. Out-of-the-money butterflies give you a clean directional target, tiny defined risk, and the chance to exit with a strong return, long before expiration. And if you want to take it one step further, the broken wing butterfly lets you keep all that, while shifting risk exactly where you want it. If there's a strategy you want us to break down next, anything from income spreads to directional plays, just tell us in the comments. We'll turn the most requested one into the next video. Samurai scans millions of options in seconds. Sign up for a 14-day free trial. Option Samurai. Find your edge now. And if you liked this video, make sure to check out the next one by clicking here and keep up with your options learning process.